Hey everyone, me Kevin here. In this video, I'm going to talk about the Federal Reserve, some crazy things happening with repos, and we'll talk about what I believe the truth is in terms of what's actually happening. And I'm going to be very clear in terms of what I do think we know with certainty and what I don't think we know with certainty. So we'll go into that. And some of this will actually relate to AMC as well, AMC stock. So these things are all interconnected, and we're just going to go through it piece by piece. So the first thing I want to say is I'm a little bit pissed with how the market works because there's a reason 70% of us believe the market is rigged. It has to do with the fact that there are so many rules and norms that exist with hedge funds and institutions that allow them not to disclose certain things. Like they don't have to disclose their margin debt. They don't have to disclose all of their derivatives, and they don't have to disclose their short positions timely. All of these things are things that really, by default, give hedge funds sometimes a short-term advantage over us as retail investors. And it's one of the reasons we kind of hate the hedgies, because think about it. Like, we have information that we can publicly get and do due diligence on, right? But so can the hedge funds. The hedge funds can get that same due diligence. Hedge funds, on the other hand, though, they know what they're doing, and they talk to all their friends. That's what happens. Come on, those wine and dine dinners, they all know what they're doing with each other. They have that special advantage of way more information over us, and that's really frustrating because they have both. They have the public DD, they have what we research because we post it all, which is fair because that's how we share it around, but then they also have their own knowledge of what they're doing internally, and I think that's why in the short term, a lot of us get very frustrated, and it's like, wow, this game kind of feels rigged because, well, in many ways it is. And I found, personally at least, the best way to deal with that sort of rigging in the market, and then we're going to talk about the Fed and AMC. I just want to get this off my chest. I've personally found the best way to deal with that is, quite frankly, hodling. Like 98% of my portfolio is a hodl portfolio. I'm hodling my AMC, I'm hodling Tesla and tech and consumer discretionary, all my favorite companies. I don't care so much about the short term. I know that in the long run, I can outperform these hedgies all day long because they're trying so hard, trading every single day, not to lose customers. I don't care. I'm not beholden to any customers. I'm not beholden to people depositing my money with my fund, right? So I don't have to play all these fancy games and try to tell them about, oh, well, look at this $100 million algorithm we have. There's a whole piece about that the other day, about how a company spent $100 million trying to do a special proprietary trading algorithm. And come on, the algorithms, they work for a few months and they stop working because other people reverse engineer it and figure it out. It's just a messy place. So, but what I specifically want to say in this is I want to talk about the Fed and the reverse repo rates because lately they felt a little scary and they've been a little confusing and concerning to a lot of us. So what I want to do is pull that up. We're going to do that here and explain a little bit of what's going on because it's pretty important. And a lot of the reason this is interconnected with the hedge funds is because we think that, or mainstream consensus right now is that, this line going way up is a really bad sign that the hedge funds are getting screwed or something shady's going on. And let's have a conversation about that. So the easiest way to do this, since we're on a phone, is literally just to point out my iPad right here, which is charging with this power block over here. But anyway, this here is the overnight reverse repurchase agreement chart. Now, I'm going to make this very, very simple in terms of what this means, but all you have to know right now is that, see how it's like really flat over here and then it skyrockets? Yeah, it's skyrocketing a lot to the point right now of over $534 billion on June 10th. And this is something that is freaking a lot of folks out. So let's have a conversation about what the heck this means, because it looks scary. It's like, oh my gosh, Fed and line going to the moon, 500 something billion dollars. It kind of implies that, oh my gosh, is somebody borrowing a crap ton of money because maybe they need more cash so they can prevent basically getting margin called on their AMC positions, and because they're borrowing so much more money from the Fed is playing the game against us retail investors to screw us. And that sounds like a really enthralling narrative because it's again, it reiterates that us versus them, right? Like, here's you and me, the average retail guy, the dude with the RuneScape shirt, getting screwed again, and the Fed's coming in to bail him out. So I spent actually most of the day here going deep into the difference between repos and reverse repos, what all of this means, and is there a real concern here Partially there is. We're going to talk about that. But what does it actually imply? So first of all, what does that line mean? What happens when that line goes up? So the line's going up. We know that, right? So the line goes up when banks have too much cash. Now that sounds crazy because it's like, wait a minute. Banks are supposed to have a lot of cash. I mean, they're banks. They're supposed to have a vault full of money, right? Yes and no. Yes, banks are supposed to have a certain amount of money, but once they have too much money, they actually run into regulatory limitations that say, no, you can't be holding this much cash. You need to either invest it or you need to lend it out. So this is where you could see some governmental regulation sort of manipulating how banks might otherwise operate with this cash. So banks have too much cash. And when the banks have too much cash, they might call up their customers and go, hey, you want a credit line increase? Quite frankly, I've probably gotten 4 of those calls in the last 3 months. It's kind of nuts how they keep trying to throw more money at me. And I'm like, no. I've already got a $7 million credit line with you, Chase. I've only borrowed $300,000 on it. I don't need more. Like, I'm good. I don't need more of a credit line right now. And I just don't want to be tempted. It's part of my reason. But anyway, I think the banks are just like desperate to get money out there, but people aren't borrowing as fast as they were last year. And this is evidenced by the growth rate in margin, or at least in one way it's evidenced by that. Well, first of all, it's also harder to buy houses right now. It's harder to spend money on things right now because some things are more expensive and people are holding off on purchases. But if you look at the growth in margin debt on stocks, you'll actually see last year at certain points it was growing. At certain points it was growing like, 5 to 10% month over month. I mean, you had these massive growth rates in margin debt. It was crazy how fast it was growing. In the last 3 months, we've had margin debt going up at the rate of a little less than 1%, a little over 1%, and the last reading was a little over 3%. So we're growing the amount of actual debt against stocks, margin debt, at a slower rate than we were before. So, this gives us a little bit of an idea of what's going on with margin debt, and now we understand that banks have too much cash. So what does this have to do with this line? Well, the reverse repo line is actually a symptom of banks taking the extra cash they have. If they can't lend it out, remember I said they can invest it? Well, something they can invest it into that's pretty much nearly as good as cash. That's not a treasury that might be losing value, a couple point, like a couple basis points, like 0.01% in the open market. You might lose like 0.01% on like an annualized rate depositing in something else right now. Where can banks put their money that's technically invested where they're not going to lose like 0.01%, which on many hundreds of millions of dollars is obviously a lot. Well, they can put the money into money market funds, and money market funds have to have their money invested in the market or on deposit with the Fed, and that's what they do. They deposit their money with the Fed. They deposit their money with the Fed trading desk, and this is known as a reverse repo. Basically, they put the money in, and they briefly hold a different security, and they trade it back the next day. It's the opposite of what oftentimes happens. Now, you don't have to understand the entire repo process. That does not matter so much. The whole point of this last, if you're confused about the last 3-minute discussion here, it's very simple. Banks got too much freaking money. And we're going to talk about why they might have too much money. So very simple. Number 1, banks have too much freaking money. What happens when banks have too much freaking money? They got to put it into money markets, which can then, until it's placed, go into the Fed system. So the Fed ends up with more of these liabilities, and banks are putting their cash, their assets over at the Fed overnight. And this number has been skyrocketing recently. And one of the reasons it's been skyrocketing recently is because on March 31st, the SLRs expired. The SLR requirements expired. These SLR rules had to do with rules that said banks needed a lot more cash on hand than they previously did because of COVID risks. So in other words, on March 31st, before March 31st, banks needed a lot more cash, and they needed a lot more treasuries on hand. They needed more reserves. When that SLR went away, banks were able to say, we don't need as many treasuries as we did previously because the requirement went away. So they could sell their treasuries, have more cash, And so now they had more cash and more treasuries. They got rid of some of their treasuries. Now they have even more cash. But wait a minute, now they run into other limitations that say, wait a minute, you have to park this cash somewhere. And that's the big line that we're seeing, at least in my belief. And what's crazy is if you actually look at the date of the line, remember those rules, the SLR rules, which you don't even have to know what those are. It's just basically rules that would have required banks to have more treasuries, and they're able to have less now because those rules expired. If you go right here, the line over here, there we go. If we could just tap it, there we go. We tap the peak over here. Oh, it keeps going away. There we go. You'll notice it jumps right here on March 31st. And so this was possibly, this whole run here is possibly a symptom of banks holding less treasuries, having more cash, and when they have more cash, they hit the limits of how much cash they can hold, and they have to throw it into the Fed money market system, well, the money market system, which throws it in the repo system. So, full recap here, and then I want to get to some bottom lines, all right? Full, very quick recap. Banks got more cash. They can't lend it out as fast. We talked about the evidence that we could look at for why they can't lend it out as fast. Talked about margin debt. We know banks have a lot of cash. We know that the amount of treasuries banks needed to hold has substantially dropped because reserve requirements have fallen, which allowed banks to dump treasuries, which means they have more cash. So bottom line is, banks have a crap ton more cash, and this reverse repo system is kind of like a buffer valve. It's like, okay, well, if you got that much cash, put it over here for now. You know, it's kind of weird and funky how it all works. It feels odd. And this is also exacerbated by the fact that the Federal Reserve recently increased the amount of people can actually, or amount of money people or banks or institutions could actually put into the repo system. Previously, there was a limit of $30 billion, and now it's up at $60 billion. And keep in mind, right now on this chart, we're somewhere around 500, no, actually the latest reading here is $479 billion, but it went as high as about 534. Okay, but anyway, what else? Like, how else does this relate to AMC? So, the most important thing to know is that this chart does not mean borrowing. It's literally banks taking cash, parking it in money markets, which show up here. It's banks having too much cash. That's what this means. Now, some folks say, well, Kevin, isn't it possible that hedge funds could be getting reamed right now because they deserve to get reamed, and that they got to come up with more cash, and so they're having more cash in the bank to offset their margin requirements? Marginally possible. Hedge funds, on average, statistically, this is researched, hedge funds statistically hold 15% of their money in cash. Not more. The other things that they can do is they can buy positions with the opposite betas of whatever they're trying to hedge. So for example, if you have a Tesla with a beta of 2 against the S&P 500 or even the NASDAQ, you might buy some Bitcoin with a beta of 0.4. It's a way to beta hedge, basically. It's a way to offset the risk in your portfolio. And so with AMC, for example, if somebody had a lot of AMC short positions, they could hedge that position by potentially buying some shares or even buying calls. And so there are other ways to hedge your position other than just having cash, and ways that would actually be acceptable for margin maintenance as well. We don't get the best margin maintenance rules. You know, hedgies, they get to use derivatives as margin maintenance. We don't. You know, in most cases we don't, that is. And again, another example of the system kind of being a little rigged here. So right now the Fed is saying, look, the process of reverse repos is working as intended. Now, maybe they're lying through their teeth and they're just total scumbags here, okay? But if you follow this, I understand it's a little more high level. And look, trust me, I'm by no means an expert on it. I've done a lot of research on this, not just today, but in the past as well. I feel like I have a grasp on what's happening with reverse repos, but I know enough to know that I don't know everything. But I do know enough to say that that line going up, it ain't borrowing. I also know enough to say that we can't say with certainty that those are hedgies depositing more money because they're getting squeezed and they're getting screwed, and it's just a matter of time before it blows up in their face. I wish I could say with certainty that was true, but I always want to be very truthful with my audience. I cannot tell you that is with certainty true because I don't have the facts to substantiate that, because hedge fund disclosure laws aren't freaking transparent enough, and there's very little for us to look up that kind of information. And that's what's very frustrating. And so 2 things that we got to remember here. Bottom lines. Number 1, there's an amazing set of programs linked down below that you can use a 40% off coupon code. Again, linked down below, where if you go to the website, you're going to see a lot of amazing programs that can help you build your wealth. And you'll think like I do too. You'll change your entire psychology in terms of perspective of what's actually happening out there in the world, okay? The next thing to remember is the easiest way to beat the hedgies is just to hodl and minimize your debt. Because if you minimize your debt, you're not going to get squeezed out. If you hodl, who cares what the number is? Do you have more shares today than you had previously, or do you have less? That's the most important thing, in my opinion. So there you have it. Check out the programs linked down below. No, I cannot say with certainty that these are hedgies trying to screw us. This is not borrowing. I want to make that super clear. The line going up is just a symptom of too much cash. And now, is it possible that that's because of inflation? Yeah. Well, there are 2 definitions of inflation, though. Remember that. One definition of inflation is the expansion of the money supply. Yes, the money supply has been substantially expanded. So yes, expansionary or the expansion of the money supply, aka that form of inflation, could mean or be the reason why we are seeing the substantial boost in reserves over on repos. In fact, if you take a look at this, reverse repos, take a look at this chart right here. U.S. factors absorbing reserve funds, Treasury General. Basically, this is the checking account of the Treasury Department. And the checking account of the Treasury Department is actually going down, that is, their balance is going down as they're spending more money. They're injecting more money into the economy. And as they inject more money into the economy, that money shows up at banks. So it's actually more possible that we have this repo figure, this chart going way up, because the Treasury Department is getting rid of their money. They're pumping their money into the economy, which shows up at banks. At the same time, the SLR rules expired, allowing banks to have less treasuries, which mean they could have more cash. But then they hit this other limit of having too much cash. And so now you got both of these factors and less borrowing, a third factor leading to, crap. All right, I guess we'll throw it over into the reverse repo market. See what I mean? So again, bottom line number 1, hodl. That is your best opportunity. Bottom line number 2, this is not borrowing, and we cannot say with certainty that these are like hedgies trying to like come out and wreck us. Although we know that that's what the hedgies are trying to do. That line going up is in my opinion not a related symptom. It's certainly not. It's suspicious, but it's not like bottom line evidence. All right. Okay, that's very important to know. Hopefully this helps you. Hopefully you appreciated this insight, and hopefully you made it to the end. If you did, you're a warrior, and you definitely should take advantage of that 40% off coupon code linked down below. Thanks for watching, folks. We'll see you in the next one. Bye.